What are you telling them? What are these positive surprises we should be looking for?
Well, as we came into the year, there was a lot of negativity. And the biggest thing that's changed since the beginning of the year is the fading of that negativity. We've had a better economy than was widely expected at the beginning of the year. We've had some expectation that rates might stop rising as they have, and that's been supported by the inflation data, which has been coming in. So what we're seeing today is an economy that is better for stocks and not threatened as it was a year ago by the prospect of ever higher interest rates. And that's set up for a very bullish market this year.
So, Kevin, you said we saw rates stop rising. Right now I'm looking at the 10-year at 4.25, one of its highest levels of the year. So when you say they've stopped rising, what do you mean exactly?
Yeah, what I'm saying is, in general, the big rise, the big surprise came in 2022. It's hard to believe because we've been talking about high inflation and rising rates for seems like forever. But at the beginning of last year, what you had was a market that was expecting essentially 0% interest rates off into the horizon. The shock came when the inflation rate began to come in very strong in the fall and spring of 22, and then the Fed had to get very aggressive in terms of tightening, and that's where we are now.
All right, so also where we are now is the inverted yield curve. It's certainly narrowed down to about 70 basis points, well below where it was. But another thing I'm seeing here, the 2-year and the 30-year from the whole range, yields above 4.25. Isn't that a lot of competition for equities that may prevent these so-called positive surprises that you're seeing?
Yeah, so we've played catch up. I mean, even if you think about the companies, the growth tech stocks that ruled the roost for the first half of the year, a lot of that was coming back off of a very significant downturn in 2022. So you've gotten to a point now where stock valuations are above average. I think the forward-looking PE for the S&P 500 is about in the upper teens, maybe 18 or 19 times earnings, a little higher than the 15 times normal. So at some point, you're right, interest rates will begin to compete a bit against equity returns. And if there was a risk case this year, that's probably it.
All right, let's talk about the consumer. I know you're looking at the consumer. Just had the jobs report come out. Wages didn't rise quite as much as expected. Unemployment up just a bit, so the labor market's not as tight. Give us a sense of what we're seeing with that and what you're seeing when it comes to consumer spending. How does that impact the market?
Well, we just published a piece on our website, WashingtonCrossingAdvisors.com, that talks about why we focus on the consumer. We want to own quality companies, which for us require owning companies that are dependable. And if there's one aspect of the economy that has been dependable for a very, very long time, it's the consumer. Consumption is really the thing that drives the economy. It's what businesses look to when they make their spending plans. And ultimately, what we're seeing this year has been a good amount of strength in the consumer, despite fears of the potential for the consumer rolling over overall. So retail sales have been strong, and even the uptick in the unemployment rate, that has more to do with people coming off the sidelines back into the labor force. So that's even showing signs of strength. At the same time as inflation comes down, that suggests that the Fed at the moment appears to have gotten it right this year, and that's a very positive thing for stocks.